there's a book. It's a very, very old book. It's like literally from I think the 1600s or something like that. It's probably one of the
Mm-hmm.
oldest books on like stocks or investing. I'm
Oh
trying to
yeah,
remember when it was.
1600s. I was just
1688.
reading about how the stock exchange. Ah, yes, I know that book. Yeah, how the stock
Hmm.
exchange actually started, and how a lot of that actually started out of Amsterdam.
Yeah, this book is about
Really?
the Amsterdam Stock Exchange. So that's why I said it's really
Yeah, and
there's
how
a
VOC, I think his VOC was the was it the exchange, and they were even buying up. And the exchange got so powerful. Think of
uh-huh,
it as like almost like a country, and they were buying up like Indonesia.
uh-huh,
Like the whole of Indonesia, VOC started to buy up the whole of Indonesia, and so on.
uh,
Like the history of the stock exchange is actually it's insane. It's insane from how
mhm,
humans can conceptualize a concept of an LLC to
uh-huh,
the stock
uh-huh,
exchange forming to it having that much power to be able
uh-huh,
to buy up countries, and it's crazy. It's crazy.
uh. Yeah,
Oh,
yeah. But there was a point I want to. I'll try to wrap this point up, and then we can
hmm
go. What I remember was that it's like the book talks about different types of investors on the stock exchange,
hmm
and from the same perspective you were talking about, from if an investment banker goes to uh, entrepreneurs, it's someone who founded some, I don't know, it's a bag juice company, right? Ticker Juice. And the investment banker says, or the business says, the business says, hey, we want to buy this new machine. This new machine should allow us to produce five times more juice than we can. And if I think there's, a good market, people will buy my product. I'm not able to meet the demand now. That should lead to me selling more bag juice, and that should lead to me making more profit. And then with me making more profit, I should, that increase like the value of the business. I can pay out more dividends and such, right? And then if the investment banker says, okay, what you can do is issue some shares to the public at a cheaper price than it's trading at. So it's trading at $3. Okay. Other people bought it at $3. We will sell the shares at $2. So it's a 50% discount. For example, I'm just saying, we were saying the same balancing act about if you increase the supply of the shares, if you don't, if what you're saying doesn't lead to an increase in the demand, you won't really get an increase possibly in the share price. But remember, that's us. We are not. So we are one type of investor. So I'll try to read the quote
hmm
from the book. So it says, um, so it said there are three classes of men, or three classes of men are to be or three classes of people are to be distinguished on the stock exchange. The princes, or I guess princesses, if it's the princes or princesses of business belong to the first class, right? The merchants to the second, the speculators to the last. He said every year the financial lords and the big capitalists, I guess saying wealthy people enjoy the dividends from the shares that they have inherited. So I guess if it was like your dad founded the company Juice and then you became CEO and he passed away or stepped down, just inherited it, or have bought with money on their own. So maybe your dad sold another business or you sold another business, you get the money, you buy the shares. He said they do not care about movements in the price of the stock. So they don't care about the share price, since their interest lies not in the sale of the stock but in the revenues secured through the dividends. So they really just care about the dividends. And they say the higher value of the shares forms only an imaginary enjoyment for them, arising from the reflection that they could, in truth, obtain a high price if they were to sell their shares. So it's basically saying that, hey, at the end of the day, what they really care about is their dividends. Like, if
hmm
the investment banker said, hey, you'll be able to increase your dividends, even if they said, but the share price may actually fall 20% for the next few years, at the end of the day, they'll do what's best for them. And there's nothing necessarily wrong with that, because at the end of the day, if they
That's
control
where
the
their
company, it's
interests
their
lie.
company.
Yeah, that's true.
No, I'm saying, yeah, like even, and at the end of the day, you are not forced to buy shares in their company.
True.
So I think that moment when I read this, and I was just like, wow, like, that. And this is from
Mm.
1688, and it's still to this day.
To
It's written
this
by this guy
day.
Joseph de la Vega. He passed
Mm.
in 1692. He was a Sephardic Jewish merchant in diamonds, financial expert, moral philosopher, poet residing in Amsterdam. And yeah, he became famous for his book Confusion of Confusions. But yeah, that was just, a ramble about that. I don't even know if this should go into like the final episode, because we still haven't even gone into how the JSE makes money. But yeah, was there anything else you wanted to add on that point about the Prince
No,
of Business?
not necessarily. It's just it's crazy how these concepts from like historical concepts are still relevant to this day, because we see it on the Jamaica Stock Exchange too. We see it with these listed companies where the interests of the majority shareholders may not align with retail investors, and they can do whatever they want. Like if they want to do a secondary offer and the share price tanks because of it, does it matter to them? No, because at the end of the day, their interests are different from our interests. So it's not necessarily that it's wrong per se. They have a different investment philosophy. So yeah,
They
but
have a different goal
they have
than
different
you.
goals. Yep. Yeah, bro.
Yeah.